Steve.
Yeah.
Oh, yeah, me, right.
Good morning.
Good morning, Joe. Let's get right to Jim Bullard, St. Louis Fed president. Jim, Joe kind of did a little curtain raise on what I want to ask, which is the market down 700 points yesterday, but more importantly, bonds. What a month for bonds. Yields are up 60 basis points on the 2-year, something like that on the 10. Does that make you happy?
Make me happy. I don't know.
To see yields rising, stocks falling, a tightening of
prices stuff. I think one thing that has happened is that the news has just been that the U.S. economy is stronger than what we previously thought, and you certainly see that in the blowout jobs report. Unemployment ticking down, not up, at a 50-year low. Job openings 2 to 1 compared to workers searching for work. Other indexes, the labor market, very, very strong. Claims still very low. So I just think you have a very strong labor market combined with more momentum coming out of the second half of 2022 than we previously thought. So that adds up to markets wanting to price in a tougher road ahead for inflation in disinflation in 2023, and I think that's basically the repricing that's going on right here.
Are you repricing as well? Among the reasons why you became of note recently was your Taylor rule graphs that showed a range of 5% to 7% for an upper range for the Fed funds rate. Is that still where you're at in terms of the possibility? Now, I know these were equations and thought exercises you did, but they haven't turned out to be totally theoretical.
Yeah, I think the 5%, I think we are going to have to get north of 5%. Right now I'm still at 5 3/8. Joe, we're going back to eighths.
Wow.
Yeah.
I don't.
5 3/8. So
5 3/8 is fine. 7.
Well, wait. Let's hear that. Let's hear it.
5 3/8. So we got a little ways to go here, and I've argued that hey, let's get to where we want to go, and then from there we can see how the data come in. Let's hope that we get disinflation in 2023. But right now, it came in hotter than we thought.
I don't think Steve meant we don't. We're not asking if you're happy or sad or joyous or depressed. We don't care about it. We're just wondering whether that indicated yesterday that maybe you're making some progress in the Fed in what you're trying to do. I mean, number one, you probably don't like the wealth effect of higher stock prices. We've talked about that many, many times. And number two, maybe you're starting to see the consumer not quite as frothy as he was with, Home Depot.
Based on Walmart?
But
Walmart
even said similar things.
Here's what you heard from Walmart. Consumers are trading down, and they're benefiting. That's what I heard from Walmart. That sounds like a disinflationary process. So I would take that as a good sign,
right?
Because that's how
you are happy.
That's how the disinflation is going to occur.
Well, so
it's those firms that are too nonchalant about their price increases are going to lose market share, and they're going to possibly forever, possibly even go out of business.